For well over 75 years, a single principle has really anchored the entire global financial system, and that's the independence of the U.S. Federal Reserve. You can think of it as the bedrock that supports the dollar as the world's reserve currency, a kind of firewall designed to separate the creation of money from the whims of politics. Well, today, that bedrock is cracking. We are witnessing right now the most significant stress test of that foundation in modern history. And this isn't a test of economic theory, but one of raw political will and institutional sovereignty.
But, this kind of pressure, it's not a new phenomenon. This tension between a president's short-term political needs and the central bank's long-term mandate for stability is a recurring theme in history. Just take a look at this diary entry from Fed Chairman Arthur Burns back in 1971. President Nixon was leaning on him hard for easy money right before an election. It's this powerful, predictable political force, right? The siren song of short-term stimulus to win votes. And we're hearing its echo today, only it's amplified and frankly weaponized in ways that would have been unthinkable even a decade ago.
So, here's our central thesis for today's briefing. What's happening right now isn't some black swan event. It's a historical cycle repeating itself. It's a pattern of political pressure on monetary policy that we have seen before. And by looking at the past, both here in the US and abroad, we can really understand the mechanics of this conflict and, more importantly, model the likely consequences for our economy and for the markets. This isn't about predicting tomorrow's headlines. It's about understanding deep structural forces.
All right, here's our roadmap for this discussion. First, we'll examine the current test of the Fed's sovereignty. Then we'll step back in time to hear the historical echoes from the Oval Office. We'll also look at what I call the authoritarian playbook from other countries, just to see the potential endgame. After that, we'll dig into the mechanics of how markets actually price this kind of political risk. And finally, we'll lay out a high-ground strategy for positioning a portfolio in this kind of environment.
Okay, let's start with today's crisis. You have to understand this isn't just a war of words. It's a real conflict being fought on legal, political, and public relations fronts. And it's creating this deep institutional uncertainty. The weapons being used aren't just angry tweets and speeches. We're talking about subpoenas and Supreme Court filings.
The current assault is just, it's unprecedented in its form and its ferocity. Think about this. We're seeing a Department of Justice criminal investigation into the Fed chair himself, not over monetary policy but over building renovation costs. It's a very clear attempt to use prosecutorial power as a political tool. At the same time, there's an attempt to remove Governor Lisa Cook for cause over allegations that predate her tenure entirely. Now, this has escalated all the way to the Supreme Court, which will have to define what for cause even means for a Fed governor. That definition could fundamentally change the Fed's independence forever. And we're in uncharted territory when you see three former Fed chairs, Greenspan, Bernanke, and Yellen, people from different parties, different economic philosophies, publicly unite to condemn these actions. That tells you something is different this time. And right here, the parallel becomes just undeniable. These headlines are separated by more than 50 years, but the political objective? It's identical. Bend monetary policy to the will of the executive. The tactics have changed for sure, from backroom cajoling to these very public legal brawls, but the strategic goal hasn't changed one bit. This is the cycle in action, playing out in real time.
So, to truly understand the gravity of today's crisis, we have to look back. There are very clear historical precedents of presidents challenging the Fed's independence. These past conflicts give us a kind of playbook for what we're seeing today, and more importantly, what we might expect to see next.
We're going to focus on three seminal episodes. First, the clash between Truman and Eccles, which, ironically, is what forged the modern concept of Fed independence. Then there's the raw physical intimidation of William McChesney Martin Jr. by Lyndon Johnson. And finally, and maybe most consequentially, the successful psychological campaign that Richard Nixon waged against Arthur Burns. Each case offers a different lesson in pressure, resistance, and ultimately, consequence.
The Johnson and Martin confrontation was, it was probably the most visceral. After the Fed raised interest rates to fight the inflation from Johnson's guns and butter spending, Johnson summoned Martin to his Texas ranch. Accounts from that meeting describe the president, who was a very large, physically imposing man, literally shoving the much smaller Fed chairman around the room, shouting at him, demanding he print the money for the Vietnam War. It's just a raw, brutal example of the kind of direct pressure that can be brought to bear.
Now, Nixon's approach was more subtle, and in some ways, maybe more relevant for today. Instead of physical threats, he used a very sophisticated campaign of psychological pressure, media leaks designed to undermine Chairman Burns's authority, and just constant private admonitions. And here's the key difference. Unlike Martin, who largely resisted Johnson, Burns caved.
He acquiesced to Nixon's demands for lower rates. The economic consequences, as we'll see, were absolutely disastrous. It proves that a quiet corrosion of norms can be just as damaging as an overt assault. So when you lay it all out like this, the pattern is crystal clear and it's pretty binary. When the Fed resists, like it did with Truman and Johnson, the outcome is either the institution gets stronger or at the very least, economic stability is maintained. But when it caves, as it did under Nixon, you get a short-term political win for the president, which is then followed by long-term economic disaster. That easy money policy that helped Nixon win in '72, it led directly to the great inflation of the 1970s. We're talking 12% inflation by 1974, something that took a decade of incredibly painful policy under Paul Volcker to finally break.
Okay, so the American precedents show us a spectrum of pressure and resistance. But to understand the consequences of a complete loss of independence, what we'd call a total capture of the central bank, we really have to look abroad. The recent case of Turkey gives us a stark and frankly terrifying cautionary tale of the endgame.
So what happens when a political leader completely takes over their central bank? The answer is this number, 85%. That was the peak annual inflation in Turkey after President Erdogan systematically fired independent governors, installed his loyalists, and forced through his unorthodox view that high interest rates actually cause inflation. This isn't just a policy error. This is the end state of a fully politicized central bank. It is the complete and utter destruction of a currency's credibility.
And the inflation, that was only one side of the coin. The other was a total currency collapse. The Turkish lira lost 44% of its value against the dollar in a single year. And that's not just a number on a screen. That is the decimation of a country's middle class. It's a catastrophic destruction of savings and purchasing power for an entire nation. Foreign capital fled, as you'd expect. This is the market's final verdict on a total loss of institutional credibility.
So we've seen the history and we've seen the international precedent. Now let's get into the mechanics. How, exactly, does political pressure translate into these devastating market outcomes? Well, it really comes down to two key concepts that every serious investor absolutely must understand.
The first is a term called fiscal dominance. This is the technical term for when the government's need to borrow money completely overrides the central bank's mandate to control inflation. In this scenario, the Treasury is driving the car, running up huge deficits, and the central bank just becomes a passenger who's forced to print the money to pay for the gas. The primary goal of price stability is sacrificed for the goal of government financing. It's as simple as that.
The second concept explains how the market reacts to this. It's called the political risk premium. When investors, especially bond investors, see a central bank losing its independence, they start to worry about the future value of the currency that debt is going to be paid back in. So to compensate for the risk that a politician will just inflate away the debt, they demand a higher interest rate on government bonds. This is crucial. It directly raises the government's own borrowing costs.
And this is where these two concepts lock into a vicious, self-defeating cycle. It starts with the president demanding lower rates. That erodes market confidence. Investors then start demanding that political risk premium. And here is the profound irony of the whole thing. That premium pushes up long-term market interest rates, the rates for mortgages, for corporate debt, the exact opposite of what the president wanted in the first place. The attempt to politically force rates down results in market forces pushing them up, permanently increasing borrowing costs for everyone, including the government itself.
Okay, so given this entire analysis, the logical question is, well, what do we do? How does one position a portfolio for this kind of environment? We're going to move now from diagnosis to a strategic framework. And this isn't about market timing. It's about structural positioning for an era of heightened institutional risk.
So how do you position for this? 3 core adjustments come to mind. First, you shorten your duration in fixed income. Long-term bonds are incredibly vulnerable to this exact kind of risk. In an inflationary environment driven by political choices, they can become what some call certificates of confiscation. The prudent move is toward short-term T-bills. Second, you have to reevaluate allocations to hard assets, things that cannot be printed by political decree. Think gold. They tend to perform very well when governments try to repress financial markets. And third, and this is absolutely critical, you must diversify your jurisdictional risk. That means looking at assets denominated in currencies like the Swiss franc, managed by central banks that are not, at least for now, facing these same kinds of existential pressures.
You know, it's useful to think of the Federal Reserve's independence as a very large dam. For decades, it has held back these powerful currents of political populism that would otherwise demand inflationary financing of government spending.
Now, as investors, we cannot repair the structural cracks that may be appearing in that dam. What we can do, however, is choose to build our house on higher ground. The goal isn't to predict the exact moment the dam might break, but to be positioned for resilience if and when it does.
I should note that our analysis today is based on rigorous research from the Federal Reserve itself, the International Monetary Fund, the American Economic Association, and the Harvard Kennedy School, as well as primary sources like presidential records and the personal diaries of the figures involved.
And finally, it is necessary to state that this briefing is for educational and informational purposes only. It does not constitute financial advice, and any and all investment decisions should always be made in consultation with a qualified professional.
So we'll conclude with a question. For 75 years, the independence of the U.S. central bank has served as the bedrock of global monetary trust. As that institutional architecture is now being fundamentally tested, not by economic forces, but by purely political ones, we have to ask ourselves, if that bedrock were to fail, what will serve as the new bedrock?